Good evening, everyone. Hope everyone had a good weekend, and hope most of you might have enjoyed India-Pakistan match today. It was a nice match, awesome match. India-Pakistan matches are always interesting, and yeah, it was good till the last hour. Hope everyone had fun. And for next 1 hour, right, as usual, I'll make sure that your 1 hour is worth spending here. You go with a lot of new learnings, new tips, new techniques, and also with some of the stocks which can move well in the next week. We'll look at all those things. As I always say, right, knowledge is wealth. Without knowledge, if we enter into options or stocks, definitely it is more, right, more like just gambling in a casino. Nothing different from that. But once we understand things better, once we understand the concepts better, then it all makes sense. You can connect all the dots, right, where we did the mistakes, right? Again, I'm not saying that uh, we all make mistakes, but if we can fix those issues, if we can fix those mistakes, and if we don't repeat the same mistakes again, definitely we can be in profits in trading. So understanding that knowledge is definitely very critical. So from last 3 to 4 weeks, we started with like what are options, what are call agreements, what are put agreements, why do you buy a call agreement, why do you buy a put agreement, and then we discussed about various terms like what is in the money, what is at the money, what is out of the money. We discussed about option creeks, like what is delta, what is gamma, what is theta, and why, right? As a buyer of a contract, what are the advantages, disadvantages, and as a seller of a contract, what are the advantages, disadvantages, uh, when we should be in the buyer side, when we should be on the seller side. And also we discussed about debit spreads in the last week. So we will, I will just quickly remind you for 5 minutes on what we discussed, and then we'll go to the next topic, which is credit spreads, and then we'll understand like, okay, why credit spreads are better compared to buying a normal calls or normal puts or buying a debit spreads. But let me quickly share, right? Just take some examples, right? I did a lot of analysis over the weekend. These are right. These are the earnings which are happening in the next week, and yeah, based on various factors, like it can be options flow, it can be technical analysis indicators, or it can be various other factors like what are the latest analyst upgrades, how the stocks are moving, what is the bullish pressure, bearish pressure on those stocks since last 2 to 3 weeks. Based on various factors, we have some stocks which are looking good for the next week, and also we have some stocks which are not related to earnings. Let us just take an example of Baba, right? We know that there is some agreement going on between US and China that to prevent the delisting of all the Chinese companies. There was some news earlier that most of these Chinese stocks might be delisted from US exchanges. But now there is a progress. So a lot of Chinese stocks, right? Again, Friday, because of that one statement from Powell, stock market tanked a bit. Tomorrow also it might continue for some time, but again, it is only for a short period. Maybe tomorrow after 1 p.m. or something, slowly it might start moving up, or from day after tomorrow again, market will start, because market will never go down. Again, there is no third world war or something. It is always just because of that one statement, right? That all families will feel the pain, the inflation will continue for a more longer period. The algo started triggering all the sales, and then once algos start selling or shorting, then all the retail traders will get panicked, they will start selling. So that went on for the whole Friday. But again, next week I am expecting, right, these are some of the stocks which seems very right, potential to move well, like Baba, Claire, NE, Zoom, Macy's, and these are some of the stocks which seems to go down further, right, which are non earnings related. Let us take an example of Baba, right? if I want to, right, if I'm very bullish about a stock like Baba, what I can do, I can buy, right, weekly. You have more risk, but you also have more reward. For example, you can see on Baba for 100 call, there is a huge open interest, huge volume, right? Even for 102, there is huge. Even for 105, right? Even up to, if you see 110 call also, there is lot of open interest. That means there are a lot of investors, traders, hedge funds, people are investing huge money on Baba for the next week. So even if you don't want to take a risk of weeklies, if you want to go with monthlies, if you see monthlies also, 110 call, there is a huge open interest of 32,000, 115, 20,000, 120, 19,000, 130, 22,000. So there is a huge potential for Baba to move in the coming week. When you are very bullish about a stock, we can just take a buy, right, directional play where you can buy something close to the right. Now the stock is around $98. So I can see, right, maybe if I don't want to take huge risk, I can go with a 100 call, right, because there is a huge open interest and the premiums are also not very expensive. It is somewhere between 2.1 to 2.17. That means I'll be paying approximately $215 for one contract. If I buy 3 or 4 contracts based on my portfolio, then I am spending, for example, I have $1,000 is my limit for each ticker. I am buying approximately 5 contracts. Right? I can do this a 100 call, which is out of the money. That means because my stock price is 98 and I am buying a 100 call, which is above the current stock price, it is out of the money. That is one way. Or as you remember, the problem with out of the money is if you go to the Greeks, you can see what is the delta, right? I make only 41 cents. If stock moves from 98 to 99, my premium will go up only by 41 cents. Instead of buying a 100 call, right, that is one disadvantage. I make only less money on every dollar move. If a stock move from $100 to $110 in next week, I only make my $2 will become $6 again, right? Considering nothing else is changing, my premiums are going from $2 to $6 if I buy a 100 call. Same thing if I buy, right? Again, let us go back and see what is the open interest for in the money calls. In the money calls, if you see, there is something like 1984, right? For 95 call, there is a lot of interest. If I buy this 95 call, right, I may be paying little more extra, 4.7, 4.9. That means I am paying approximately $480. Instead of spending $215, I am spending $480. But I have two advantages. What are the advantages? The advantage is I will make 62 cents for every dollar move instead of 41 cents. If stock moves from 98 to 110, I'll be making a lot more money, lot more profits. That is one advantage, right? It is 67 cents for every dollar move. And then with Gamma, on the second dollar move, I make 72 cents. On the third dollar move, I make 77 cents. Like that, I keep making more and more money if I buy in the money call compared to out of the money call. That is one advantage where instead of making 41 cents, you are making 67 cents by buying a 95 call. What is the second advantage? If you remember, right, there is something called as intrinsic and extrinsic, right? You have, right, when you're buying a 95 call, what is the intrinsic value? That means 305. That means the stock price is 95, current stock price is 98. Already $3, you already have value. What you are paying for time value, for implied volatility, for all the other factors is only 1.75. Whereas if you are buying a 100 call, all your money you are paying for 2.1. That means if it takes more time to move to 101, 102, you are losing all this money. you have lot more money you are spending for time decay and also for implied volatility by buying a out of the money call compared to in the money call. In the money call, you already, right? Already you have money in that. That means you are getting into an agreement saying that you have right to buy the stocks at $95. Even stock goes to 110, 120, 130. Now you have a right to buy the stock at 95. Even if it doesn't move also, even if it stays at 98 also, still you have $3 worth of money in that contract. That means still you have money. You are not losing the entire thing. You only may lose this 1.75. Whereas here, if stock doesn't move, you are losing your entire 2.135 completely. So one advantage is you make more money because of the delta and gamma when you are buying in the money calls. The second advantage is you have more intrinsic value, and then you have less extrinsic value, which you are spending for the time and for the theta, right, time decay, implied volatility, all those things, you are spending less money. So whenever you are very, very confident about a directional move, right? For example, Baba, I am very confident that this stock can move well in the next week. Then I can just buy a call instead of, and what you want to buy, it depends on your account size, right? If you have a small account, you may buy 100 call. If you have a big portfolio and you are very confident, you can buy some 95 call. It is up to you, because you make more money if you buy 95 call. If it moves as per your expectation, as per your analysis, if it moves, you make a lot more money here compared to buying a 100 call. Also, risk is also same thing, right? You will lose 61 cents for every dollar if it goes down from 98 to 97, 96, 95. You will be losing 61 cents, whereas here you will be losing only 41 cents. So you have higher advantage and also higher risk with respect to delta and gamma. But if you are very, very confident, if you see that there is a huge potential, then it is always, that's what hedge funds, big organizations, what they do, they generally buy in the money calls, whereas retail traders, they buy out of the money calls. And as I mentioned, the delta also shows us what is the possibility of stock going to that. If you are buying a 110 call, your probability of making money is only 9%. If you are buying a 95 call, your probability of making money is 67%. Right? If you are buying, going more and more out, you may be paying lower premium, but your risk is becoming more and more, and you may lose the entire money unnecessarily. So never go too far from the current price, right? If you want to buy out of the money, buy somewhere close where the open interest is good, buy there. Or if you have a good big size account, buy somewhere within the money where there is a huge open interest and where you have where you are very confident about the move of the stock, right? That is like when we have to buy calls, when you are very confident about the stock move, then you can buy out of the money, which is closer to the current stock price, or you can buy in the money where you have good open interest and also you have a good delta and a gamma, so that every dollar move will give you more and more profits. But the risk with calls, right? These are called as naked calls. That means only if stock moves up, you make money. If stock stays there or if stock goes down, you are losing your premium. Whatever you paid, that can become completely zero, especially if you're buying out of the money call. Whatever you paid, that $215 per contract, that can completely become zero if the stock is not moving, or suddenly there is some other news of some China-Taiwan war or some other Ukraine-Russia against some war, right? All the technical analysis, everything will become invalid with the fundamental catalysts like news, such type of news, right? That's what happened on Friday. Because of that statement from Powell, everything, right? A lot of Tesla, everything was looking good. But because just of that statement, every algo was triggered, everybody got panicked, lot of sell-off happened. Right. So, but if you are confident, if market is is in a normal condition, if VIX is less than 20, then always you can make a lot of money. But if position, if stock doesn't move in that direction, you can also lose money, right? So that is the problem by buying a call. In the same way, put, right? We discussed about, let us take one example, right? Let us see LEN or FSLR, they are looking very bearish next week. So let us take example of FSLR. Let's look at open interest, right? There is a lot of open interest at 107, right? The stock is currently 121, but there is a lot of open interest at 107. That means there is, right, hedge funds or people are predicting that the stock can go less than this 107 or something. So if you are bearish, if you think stock will move up, you buy a call. If you are bearish, you can buy a put. For example, you are spending $20 for one contract. If stock goes from 121 to 107, your $20 can become $200 or $300 also, right? Whatever you are spending on this, because now you are getting into an agreement saying like, even though stock goes to 100 or 90, whatever it is, they have to sell you the stocks at 107. So if stock starts coming down, then these premiums will start increasing. So your contract value will start going up more and more. So there is a huge open interest here. So this or maybe somewhere here, 402, like that, right? If you think weeklies are risky, you can see what is the open interest in the monthlies, right? 120, there is good open interest. 115, 110, 105, 100, there is good open interest. That means there is a potential, right? If you see on the call side, generally the, right, except this 130 call, there is very less interest for the investors. But if you see here, 120, 115, 110, even 105, even 100, there is a huge interest for the investors. They are buying contracts. That means they are expecting, right? Technical analysis is showing that FSLR moved a lot. Now it will start going, right? Stocks will not continuously go up or continuously come down. They go up certain point, then people will start taking profits. They will come down. Again, there will be some consolidation. Again, they will start moving up. Again, they will. So it is all about, we have to pick the right point to buy and sell. So now this, right, in this case, what I can do, I may buy some 120 puts. That means I may pay 4.5, but if stock starts going down more and more, my $450 can become $900, $1,500, right? As it goes more and more down, my value of my contract will keep on increasing. So when you are confident, again, you can buy out of the money put contract, or you can also see, right, there is some good interest here at 125. You may be paying little more, but your gamma will be more. If you see what is how much money you can make, you will be making a lot more by buying a put compared to buying a out of the money put. By buying a in the money put, you can make more profits. So, right, in the same way, again, the intrinsic, extrinsic, just like what we discussed in the call, right? The call side, put side also, it is the same thing. Right? You have less risk, you will be paying less for the extrinsic when you are doing in the money puts compared to out of the money puts. So it is up to you. Again, when you are very confident about that the stock will go down, you can buy a put and you can make money. You can buy out of the money or you can buy in the money. By doing in the money, you make more profits if it goes in the direction whichever you anticipated, because you have higher delta, higher gamma, you have less extrinsic value, you are losing less with the time decay and implied volatility, all those things, you are losing less money. But again, the risk is with not naked calls or naked puts. The risk is you expected something, but if it is not happening in the same way, the problem can be your premiums will completely become zero. Right? That's what we discussed. That's why, what is the next solution? We discussed about debit spreads. What do you mean by debit spreads? Instead of just buying, right? We discussed like what is the advantage for a seller, right? As a buyer, I can make profits only if stock moves up. if I buy a call. But as a seller, even if stock remains same at the same place without moving, or even if stocks goes down, or even if it moves up, but it takes a lot of time to move up, or if it is keep going down, coming up, keep going down, there is a lot of implied volatility, still I can make money as a seller. So seller has a lot more chances to make money compared to a buyer, right? That's why hedge funds, all those generally they do lot of selling compared to buying, whereas retail traders, because they have smaller accounts, because when you want to sell, you need a collateral. If you are selling a contract, you need to have a good amount so that you can buy 100 stocks of that particular stock price. But as a buyer, you have to just to pay. You don't have any obligation to buy the stocks. You have just right. So you are only paying the premium, even though you have a small account, a 5,000 account also, you can do it without much problem. But whereas hedge funds, because they have a huge money, they have ability to do lot of selling and they can make lot of profits. Even if stock doesn't move, if stock goes down, if stock moves, but it takes a lot of time, there are a lot of ways they can make money. So instead of just buying a call, in debit spread, what we are doing, we are buying a call and also selling a call. So we are reducing the risk. Instead of investing, let us go back to the same example, right? Which we discussed, right? Baba, we see that there is a lot of potential to make money in the next week. Now, instead of me just buying a 100 call, what I will do is I will buy a vertical. Instead of buying a naked call, I am buying a vertical now. So what I am doing, I am expecting Baba will go somewhere between 100 to 105. So let's say I want to buy 5 contracts of 100 and I want to sell some 105 or 102. So my cost went to 80 cents, right? Earlier my cost was, if I want to just to buy this one, my cost was $435 for every contract. That means if I want to buy 2 contracts or 5 contracts, my cost is so much. But now if I am doing a vertical so that I am reducing my cost, right? If stock goes to 100, right, my cost, right, from 450 or $430, my cost dropped to $80 now, because I am buying and also I am selling a contract. So my profit might get reduced here, right? If I just buy a naked call, if stock moves up to 100, 105, 110, I may make 300, 400 profit. Whereas here, because I am also selling a 102, if stock comes up to 101 or 100, 101 or comes to 102 also, I will be in profits. I will make profit on this one because I sold, I got the premium. I can make profit in this way, and also by buying a call, I can make profit. By selling a call, I can make a profit by doing a debit spread. You are only paying $80 instead of $400. But only risk is, or only disadvantage is if Baba is going to 110, then instead of making a huge profit, your profit got reduced now, because you also sold a 102. It will also start going up as stock moves above 102. This will keep on, your premium contract of value will keep on going up, and 102 you sold it. So you have obligation to sell the stocks at that 102 price to them. So your investment got reduced, and also if the stock moves so well, your profit potential gets reduced. Still you are making money. Only thing is, instead of making maybe 200%, 300%, you may make only 50. You have a defined risk. You know that maximum you lose is $80. Maximum you can make is this much profit. But your risk got reduced and your profit potential also gets reduced. So if you have a moderate risk level, you don't want to take a lot of risk by just buying a naked call or buying a naked put, you can do something called as debit spreads. You are buying a call of a something like 100 and you are selling something like 102 or 105, so that if stock exactly comes to here by the end of the 16th September, then you may make profit in both the sides. If stock even comes to somewhere between or even up to 105 or 110, by the date you can still make money. But if stock goes so high, then you may make only limited profits. In the same way, put side also you can do the same thing, right? So that is debit spreads, which we discussed in the last week, where if you buy a call or put, that means you are taking a huge risk. You don't, if only if things move as expected, you make money. If not, you are losing your entire premium and it can become zero. By adding a protection, by adding another layer, right? You are not just like a buyer. If you want to just to sell, the problem is you need to have a big account. You need to have potential to buy those 100 stocks. You need to have a collateral of that much money. So you cannot just sell. You know that a lot of ways to make money by selling calls or selling puts, but you need to have a bigger account. So you cannot be like a hedge fund where you can just do selling. So instead of that, what we are doing, we are buying a call and also selling a call. Your investment is getting reduced. Your profit potential, if it comes to exactly that price or somewhere between the first and second ones, then you are making profit in both the ways by selling, because you have theta decay, you have implied volatility, all that premium you collected. So that is yours. And by buying a call, stock is coming to 100, you are also making money. So that is the advantage of debit spreads. But one thing you need to remember is still you are you are paying here, right? Even though your investment got reduced from $430 to $80, still you are making you are still making a payment. That means even that $80 is also a risk. If stock only again moves up, you make money even with the debit spread, right? As we discussed in last week's, right? Whom do you think make more money, whether a casinos or the people who go to casino? What do you think? Who makes a lot of money? Whether casinos make more profit or people who go to casinos, right? There might be 5%, 3%, 4% who may go to casinos may make money, but remaining 95% will lose. So casinos are on the profit side. In the same way, insurance companies and the persons who are paying the insurance, right? We all might be paying car insurance, home insurance, health insurance, life insurance, but only 5% might be using, right, raising a claim. Remaining 95% are just paying for a protection. So the companies are making more profits. In the same way, do you want to be a buyer or do you want to be a sell on the seller side? If you want to just to be on the seller side, you need to have big accounts. You need to be like a hedge fund with a lot of money. So by doing a debit spread, you are still a buyer to some extent because you are still paying, right? Instead of $430, you are paying $80. But with a credit spread, what you do is whenever you are bearish about a stock, instead of just buying a put or something, you sell a call at a higher level and then you buy at a lower level, right? So again, let us go to the example of what is the stock we discussed, which has a potential to go down, FSLR, LEN. Let us take one example, right? FSLR. So again, I am bearish about this, right? Assuming that this stock will go down. So what I do is I will, let me look at the open interest. In debit spread, what we did, we bought this call, right? And then we sold this call. Whereas now, when I am bearish, I will sell this call and then I will buy this one, right? So that my investment, because if I only be a seller, my risk is if suddenly stock doesn't, right, instead of going down, if it goes up, I have a huge risk. With a small account as a retail trader, I have a bigger risk. So what I can do, I want to sell, and I want to sell a vertical. So now if I want to sell to, now my, right, I am collecting the credit now. Instead of me paying, I am acting like a seller, and I am reducing the risk of, so because I am also buying a call under that, so that my risk got reduced. I am not paying, or I am not collecting this entire money, and then if suddenly stocks start moving up, I may have a huge risk. So what I am doing, I am selling this call, and then I am buying this one, right? You can ask, like, when you are bearish, when you are confident, why don't you buy a put, or why don't you just sell a call? We can do that, but that is like a naked call or a naked put, where you have a higher risk. If you have a lower risk tolerance, right? As I told, everyone has a different risk appetite, a different risk tolerance. You have a different account size. Nobody knows what is your risk tolerance, right? The analyst might be posting something where he's okay to lose $5,000, $10,000 because he's confident that he can make money on the next trade or the third trade. But your risk tolerance might be different, right? You may not be able to sleep even if you lose $500. That entire night you will be scolding yourself, thinking why you took the trade, or why you did that. So based on your risk tolerance, right? If you are buying a naked call or naked put, you are taking a huge risk. If stock doesn't move in that way, your entire premium can become zero. You can do a debit spread, or when you are bullish on the call side, you do a debit spread. When you are bearish on the call side, you do a credit spread. So what you are doing, you are selling this 120, right? Just for example, right? This 122 call, and you are buying 123 or 125 call, so that your risk got reduced, and you can make money in multiple ways. One is because you sold, and if stock goes down, you can make money. Second thing is, right, you bought this one, so you have a lower risk. Even if stock moves up also, now your risk got reduced. And because of theta decay, time value, all those things, even the stock remains same place, right? You are making all the money because you sold a higher call, right? As a seller, you have a lot of ways to make money. Even if stock is not moving, staying there itself, you sold this one, so you are collecting all this money, and you can make more money. So I hope everyone is clear, right? When you are doing a debit spread, we are buying this and selling something below that. Whereas in a credit spread, you are selling this and you are buying somewhere below that. That means you are receiving a credit instead of paying, you are receiving. If you have to be just a seller, you need to have a big account. Because you don't have a big account, what we are doing is we are selling a higher strike price, and then we are buying something a little less, maybe one or two strikes below that, so that your risk got reduced. And as a seller, you have a lot of ways to make money. In that way, you are basically at a higher chance of making profit compared to loss, right? The first option, most risky, is buying a naked call or buying a naked put. That is the most risky one. Little better is a debit spread, where you are buying a call and also selling a call. You are still making some payment, but the risk is low now. Instead of investing $400, you invested only $80. If it moves as expected, you make some profit. So if you are a moderate risk tolerance guy, debit spreads are good for you. If you are a high risk taking guy, right, buying a naked call, naked put is good for you. If you are a low risk guy, right, you are happy. Even if you get 5%, 10% profit, you are happy, but you don't want to lose money. You don't want to lose your sleep. You don't want to lose your peace in the life. credit spreads is the best one. So your risk depends, right? As you take more and more risk, profit will increase, but risk is also increasing. So try to understand, right? Where, right? Do I belong to the aggressive or a moderate or a low risk type? If I am a low risk type, maybe credit spreads has the lowest risk, has a lowest, right? Maybe you make, instead of making 100%, you may make 20%, but you have higher chances of making money because you are selling and then buying a little lower call. So your risk got reduced. You are making money through time decay. You are making money through implied volatility. You are making money through, if there are interest rate changes, you are making money. All those option Greeks are helping you as a seller. So that's what we need to understand. And then take the right, even the analyst might give you a naked call, right? Let us say analyst is giving, right? Again, let's go back to Baba example. Analyst is giving a 100 call, but you are a moderate risk guy. You don't want to take that entire $430 risk. Maybe you sell, right? Buy this one and sell this one. So now your risk got nearly 50% reduced. If stock is exactly somewhere between 100 to 105, you are making money in this way, in this way. With a lower investment, you make more money. If stock goes above 105, still you make money, but little less than buying a naked call, right? Or if you are a low risk tolerance, right? Instead of, right, whenever he's giving a call or he's right, you can go to the other side and you can do a credit spread, right? You collect, right? For example, you sell 99 call and you buy a you sell 99 put and then you buy a 96 put. In that way, you are collecting the credit when you are making money, right? I hope that is clear for everyone. You have three different levels: buying calls, buying puts, which is the highest risk. Only if stock moves in the same direction, we can make good profits. The second category is moderate risk, which are like debit spreads. Still you are making payments, but your payments got reduced by 50 to 70%, 80%. So your risk on the same trade, you are taking a lower risk. So instead of taking 100% risk, now your risk is only 25 to 30%. Your profit might get reduced, but you have a defined risk. You know what is the max profit you can make, what is the max loss you can make. And now if you lose one trade in a naked call, naked put, with debit spreads, you can lose 5 trades because your investment is only 20%. Right? So you have more chance to play, you have more chance to take more plays when, especially if you have a small account. That is the way to do. Third way, even instead of doing debit spreads, you can do credit spreads and then make more low risk, right? Lot more less risk compared to debit spreads, and you can make less profit, but the potential, the probability to make profits is much more higher in credit spreads compared to calls or puts or debit spreads. You are playing like a hedge fund where you are selling, but also you are buying because you don't have a huge account to maintain all the collaterals. So you are also buying, and you are getting that value from the time decay, from the implied volatility, because you sold it. So if stock is not immediately moving, if it is taking time, right? We discussed that every option premium consists of different things. You have time value, you have implied volatility, you have interest rate changes. All these things will help you as a seller. As a buyer, all those things are against to us. As a seller, all those things will help us. So in a credit spread, you are selling first and then buying next. In a debit spread, you are buying first and then selling the little lower strike price contract. Whereas in credit spread, you are doing opposite. So you have more potential to make more profits compared to doing it as a debit spread. So let me quickly, right, what we discussed till now. If you are most aggressive, long calls, puts, right, which are naked calls or naked puts, you can make a lot of profit only if the stock moves in the same direction. If the market is so choppy, if it is completely news driven, right? If market is like 2020, 2021, where things just keep going up, if it is a normal condition market, then maybe calls and puts are good for you. You can make a lot of money. Or if you are an aggressive player, right, even in this market also you can make money if you are aggressive or if you have higher risk tolerance. Most profit potential, but you have more risk. Only one way of making money. Only if you buy a call, stock should move up. If you buy a put, stock should go down. Then only you can make money. Whereas you are little conservative, right? Average, moderate, then debit spreads. Your investment is reduced from 30 to 50 or more than that. But instead of making more profit, you will make lower reward. Then you are low risk tolerance guy. Right? You cannot sleep or you cannot talk with anyone. You feel like frustrated with your situation. Whatever trade you take in, it is losing. Everything else is making money. Right. You are in that situation. You are feeling that things are not going well. Then credit spreads are the best for you. The lowest risk, lowest reward, highest probability of success, and there are more ways to make money because you are selling first. So all the time decay, implied volatility, interest rate changes, all those are helping you on the first one. On the second one also you can make money. So you have more ways, or you have more potential, more probability, 85% of making money with a credit spread. But you have a lower, right? If you are making 100% here, you may make 50% here, you may make 25% here. But here you will lose 100%, here you will lose 50%, here you will lose only 20 or 25% if things go completely opposite. So you have to decide which is good for you based on your risk tolerance, and then play accordingly so that you can be on the profit side. If I want to make a lot of profits, but I have a low risk tolerance, that's where all the problem comes, right? Either you have to take high risk for higher profits, where it can go 100% up or 100% down, or you have to take low risk and make low returns, right? You might be content with smaller profits. Instead of making red and losses, you are okay to take small per 10%, 15%, 20%. Also, you are happy, right? Anything green is good rather than losing 100% on a trade. Making some profits is good so that you can slowly build. Your compounding will help it. On day one, you may make 10%. On next day, 10% plus 1%, 11%. So your compounding will slowly help you to build your account, right? So that's what I wanted to explain each of you, because that's what we do most of the time, right? In the alerts channels or anything, we just go without understanding what is our risk profile, right? Am I okay to lose? Am I okay to lose 100%? Am I okay to lose 50%? Am I okay to lose 25%? And based on the alert, you can also make little change to that, right? The same call, you can change it to a debit spread. So your risk got reduced, right? It might be a bullish call. KC or MG might be giving a call. You can convert it into a debit spread and buy the call and also sell something one or two strikes below that, so that your risk got reduced now. Your investment, right? Your risk from 100%, now your investment is only 40% or 50%. Still you can make profits, or even if stock doesn't move also, your loss is less compared to buying a normal call. Same thing, you can also change a call to a credit spread and you can make profits. So you have higher per 80 to 85% of trades. If you take credit spread, we can make money. 60% on debit spreads, you can make money. 25 to 30% on calls and puts, you can make money. So especially this is news driven market. Powell talks something, immediately everything goes down, or somebody says something good, everything starts going up, right? Technical analysis is not working in this year, right? Your support levels, resistance levels, if it is going down, it went nearly 3 to 4 resistance levels. It broke 4 resistance levels on Friday. right? Generally what happens in a normal market, if it goes to the next level, then it starts coming back again, right? But because these fundamental news are driving the market, if you have a low risk tolerance, you want to take low risk, right? Definitely credit spreads is a good candidate for you. So long vertical, right? The debit spreads are pure directional plays. You make profit only in one of the three, right? Only if you're buying a debit spread, only if stock moves up, you make money. But when you are doing a credit spread, you can make, right? Even if stock stays there itself, you can make money because you sold the call, right? Because you are a seller first. You are a seller first and then buyer. So even if stock is not moving, or even if it moves little, or if it is going down, in all the three ways you can make money as a seller, right? If you are doing a credit spread. Debit spreads will give you a lower probability of success but higher potential, whereas credit spreads will give you higher probability of success but lower potential, right? You make 85% of your trade successful, but you may make only 10%, 15%, 20% from each of those trades. Here you may make 50%, you may win only 60% of the trades. If you're buying naked calls, naked puts, especially if you're doing out of the money calls, out of the money puts, you may make 100%, 200% on the trades, but you may win only 25 to 30% of those trades. So it is up to you to decide which one you feel better, right? Some of our analysts like PB, HK, they give debit spreads and credit spreads. Some analysts give pure calls and puts. It is up to you to decide which one, right? Which category you belong to. Do you belong to aggressive category, moderate category, or a low risk category? And then decide upon which one, so that you make profits, you will be on the greener side, right? Otherwise, if my mentality is something, I am taking something, then not only losing money, we also lose the sleep, we also lose the family time, everything, because you are frustrated with everything, whatever is happening. So that is very, very important in trading, and understanding why to be right, why it is advantage to be on the seller side, right? We always, as a retail traders, we think like there is a limited risk. As a buyer, we try to be buying calls, buy puts, but as a seller, you are like a casino now. You are not someone who is playing in a casino. You are like an insurance company, right? You are not someone who is paying the insurance. So you have more advantage to be on the seller side. But because we have small account, you cannot be on the seller, completely on the seller side. So you are primarily on the seller side, and then to protect, you are on the buyer side, so that you don't need a big account. With a small account also, you can do credit spreads because you don't need huge investment. So when you have to buy, right, buy the debit spreads when the volatility is low, right? If the VIX is below 20, if market is good, then you can go with directional bets, right? You buy calls or you do debit spreads. Whenever volatility is high, if VIX is, right, for example, Friday, VIX was 23, 24, it is moving like that, then you have to be better to be on the seller side. You do credit spreads. Then you make more money. There is a lot of volatility. So you are making money from the implied volatility, right? Vega, you are making money from the time decay. Your theta is helping you as a seller. Delta, gamma, they are helping you as a seller. So whenever market is good, whenever it is green, when your ES, NQ are going up, your VIX is below 20, you do either normal calls, normal puts, or debit spreads. When it is too volatile, when market is, right, you don't know what is happening, suddenly things are changing, there is some right, it's a FOMC meeting, or you are expecting a lot of volatility, on those days it is always better to do credit spreads. You sell the spread, you are collecting the premium, so you are on the seller side, you make a lot more money. Whereas on the buyer side, when things are normal, when market is good, when market volatility is low, VIX is low, ES and NQ are on the uptrend, do the debit spreads. When it is in the opposite direction, ES is coming down, NQ is coming down, VIX is going up,